Hello, everybody. I'm Jack Lowenstein. I'd just like to say welcome to everybody from who's an investor in our Morphic Ethical Equities Fund and our Morphic Global Opportunities Fund. Very pleased to see you all. If everybody's got a cup of tea and a presentation, I think we'll begin. I'm joined today by most of my colleagues from Morphic. The chairman of the Morphic Ethical Equities Fund is sitting in the front row here. That's Joanna. And on my left, I've got James from Morphic, Chris from Elliston, I'll talk more about in a minute, and my colleague Chad also from Morphic. So, welcome. For those, I see many familiar faces here, but I suspect there's a few who aren't so familiar, so I'm going to just briefly go through some slides some of you have already seen. Morphic Global Opportunities, Morphic Asset Management was founded about 7 years ago, almost exactly 7 years ago now. The origins of the firm, for those of you who don't know, is that my colleague Chad and I left another firm called Hunter Hall, set this business up to try and provide global equities with a risk-managed profile to try and make sure we participate in the upside as much as possible while trying to manage risk during downturns. I have to say the amazing thing is, since we launched the fund, we haven't actually seen a major downturn, so hence the fact that the direction has been pretty much all that way. We now manage 3 funds. As I said, the Morphic Ethical Equities Fund, which is our listed investment company, the Morphic Global Opportunities Fund, which is our original unit trust, and a new unit trust which invests in a European fund we manage, which is available to Australian investors, primarily targeted at European investors who want to invest in what is actually, incredibly, the world's first ethically screened long-short fund investing in equities. It's quite extraordinary that an Australian company like us should have dreamt up a concept which is in quite high demand in Europe and where we've seen a lot of growth, which is looking at a more traditional hedge fund strategy with an ethical overlay. As some of you may have seen, in the last week we announced that we have our business, Morphic Asset Management, has been acquired by Elliston Capital. Elliston is a very, very well-established, large investment management business, and Chris is here from Elliston today. We're very excited about this because I think after 7 years, Chad and I have come to the conclusion that the thing we're good at is managing money, but that managing a small business is a bit of a strain on resources. So the outcome of this takeover or merger is that, and that's why I feel very happy about, we get asked what's going to change, and our first answer is to say nothing, and that is literally true because all the investment team will be and indeed all the marketing team will be transitioning to Elliston as a group and working to some extent as a division within Elliston. But actually it's not really true because some really positive things are going to come as well. The first is that I will no longer have the misfortune of having to manage a small business, which I can tell you is many of you in this room will know that managing a small business is a very time-consuming task, and be able to devote all my resources now to managing money, which I'm very excited about. The second thing that's going to happen is that we will now have access to a much broader pool of analysts within the Elliston Group to find ideas for us to invest in, which is very exciting. And the third thing, and this is really more focused, I guess, on those people in the room who are investors in the Morphic Ethical Equities Fund, is we're now going to have a deeper marketing pool to tell the Morphic story and to try and get what I find a very, very annoying discount to NTA. That's the discount between the share price and the value of the assets in our listed investment company, try and close that gap. So those are the three real pluses I see from this transaction, and I look forward to any questions on this shortly. Now, I'll let Chris speak at some point if you choose to ask him about why it is Elliston wanted to acquire our business, but in my view, it's pretty obvious. Ethical investing, ESG investing, and I'll come to what these terms mean in a second, is rapidly growing. It's probably the fastest or the major growth area in funds management around the world, because more and more investors are saying, it's not just about making more money for my savings and so on. It's also about making sure that as I make that money, I'm not making the world a poorer place. So that's why it's a very fast-growing category, and obviously from our point of view, we wanted to make sure when we did a transaction with Elliston that they recognised the opportunity there, and I think it's fair to say they didn't just recognise it, they embraced it. Just a little bit of a refresher about what exactly it is we do. We are what is known in the broad context as a responsible investor, but that means many things to many people. Traditionally, what it's meant is sort of values-based investing. And this is because the origins of the whole concept tend to go back to people like church groups who had money to invest, where they wanted to be sure their money wasn't being invested in activities they felt repugnant. And chief amongst those were so-called sin stocks, things like alcohol, tobacco, and gambling. But more and more, as time has gone by, it's also evolved to mean things like climate companies engaged in making climate change worse, or other forms of environmental destruction. And that is a big part of what we do. We have a negative screen, and I'll talk about that in more detail in a minute, of things we don't do. And that's really, I think, to many people in Australia in particular, that's a very important part of our activities. As time has gone by, though, people have decided to get more focused, not just on wanting to know about what the companies they're investing in through our funds are doing. They also want to know about how the company is being managed. And so the three buzz letters, if you like, or the acronym for that is called ESG, which means environmental, social, and governance. So that people want to make sure that even though we're investing in companies that pass our negative screen, the businesses aren't being managed in a way that involves environmental destruction. They also want to know that the companies aren't being managed in a way that, for example, treats their workers unfairly or illegally. That's the social part primarily. And then governance is all about making sure the companies we invest in not only run good businesses, but make sure the benefits of those businesses flow to us as shareholders and to invest in our funds as returns. So that's ESG. Now, we've done a lot of work on this, and my colleague James here has built a fantastic tool which we call our ESG audit, which looks at these issues. And the primary thing we're trying to do is to look at this as part of our risk management process. So if a company is operating within, it's not something we screened out, but is operating in a way that is basically getting a free ride from abusing the environment, our view is that's not going to be sustainable. At some point, that company is going to be called to account, and when it does, its apparent profitability will be shown as a bit of a sham. There's an economic term for this, it's called an externality. It's been enjoying a free ride, an externality, and when that externality is removed, its profits will go down. So we're looking always to find companies which have been getting that kind of free ride. The same is true with things like labour abuses. If a company has been, and it's a very good example of this, I think where we've seen in Australia, a lot of companies in Australia, even in the listed space, have been shown to be not obeying minimum wage requirements and so on for their industries. And when that happens, their share price gets pounded, or even if it's just a suspicion. So a good example of that would be a stock that we have previously shorted called Domino's Pizza. Its share price peaked at about $80. When problems emerged with the way its franchisees were paying their employees, its share price has virtually halved since then. And then governance, this is a very interesting area. One thing we know is that perfection is not necessarily a good opportunity for investment. Your real opportunity is to go to a company which has got not perfect governance, but there's a prospect for improvement, and then agitate for improvement to get uplift in value. And we've got a very good example of where that happened, where my colleague James identified a company where we thought there was a step shift in the way the company was being governed. As a result, there will be upside for us, and we'll talk through that in a minute. So those are the two main things that we do at Morphic. We also do have at least part of the fund always invested in what we call thematic sustainable stocks, which are stocks which are trying to work to make the world a better place. We don't, and those are the three elements of responsible investing that are most focused on investor returns. We don't, going to the far right of the slide above, we don't think it's our job to give your money away, but we do take, I should say, we do take some of the fees that you pay us to manage your money and give that to charity ourselves. And in Australia, the main charity we do that for is a company called, a business called Bush Heritage, which is one of the largest private landholders in Australia now, and basically operates a series of privately run national parks across bushland that has very high environmental elements. On that issue of charitable giving, we've been going for a little over 2 years now as a business at Morphic Ethical Equities Fund, and we've given $31,000 from our shareholders' funds at Morphic Asset Management to charity in that time, to Bush Heritage. We also managed some money for a project of Jeff Wilson, who many of you will know, called the Future Generations Funds, and we managed that money without collecting any fees, and our total fee, if you like, the amount of money we've rebated to youth mental health over the last 5 years to about $700,000. So we do the charity either by not charging fees or by paying part of our fees away. Quick refresher about what our Morphic Ethical Charter is, and this is on our website. Our chart, the red dots represent the stuff that we don't do, and the green dots represent the stuff that we try and find some opportunities in, obviously subject to us expecting to make money from them, which are, and those things are mostly stock companies involved in water quality, air quality, conservation, or renewable energy. Portfolio position, I must apologise, this slide is a little bit out of date. This is a portfolio as at the end of April. We haven't yet updated the slide for May, my apologies for that. But not too much has changed. Our biggest position at the end of April and also at the end of May was still Alstom. Don't blame Alstom for the fact the trams aren't running down George Street yet. It's not their fault. They've built a beautiful set of trams. I've seen them parked. They look absolutely fantastic. Unfortunately, not going anywhere yet, but they are fantastic trams. They also built, if I remember rightly, James, the new metro that's just opened going to Chatswood through Ryde. They are the world's number 3 player in global mobility. They're based in France, but they're a truly global operator, and I'll talk a bit more about them in a minute, but it's been a very good investment for us. And I think really part of what I think we've got to try and do more of to get our returns up, which is to find great long-term themes and stick with them. The stocks listed, shown in gold here, are our short positions, and the first was our second largest position in terms of portfolio exposure at the end of April. We've trimmed it a bit since then. Is a company called Huadian Power, which is one of China's least efficient, most polluting coal-fired power station companies. The reason we're shorting it is because it's part of a pair with China Everbright, which is a waste-to-energy company, which essentially deals with the problem of urban waste in China, which is a very big problem and getting bigger, because unlike us, they've got no land to dump waste in anymore, which is not a very good thing anyway. And what they do is they have a very highly environmentally credentialed set of incinerators around China to burn the waste, to dispose of it, and also generate electricity, renewable baseload electricity, which they sell to the grid. And our view was by pairing it with the least efficient coal-fired power company in China, we were removing our China risk, our renminbi, the Chinese currency risk. The fact it's listed in Hong Kong was also being hedged out. And the only remaining risk was, to be honest, was whether the coal price would fall enough to try and give to have the effect of giving YDM Power a bit of a tailwind. But their real problem is that increasingly in China, they're burning coal less as part of the power mix, so the amount they get that this station gets used, or their stations get used, is less and less. Service Corporation, another very long-standing stock in the portfolio, is America's largest funeral home operator. They can be compared in some ways with Invocare, which is an Australian company many of you will know, except they're about half the price in terms of PE. And also they haven't got the market scale that Invocare has, so they can still grow for acquisition. It's a very well-run company, and it's obviously got, I hate to say it, rock-solid credentials in terms of it's never going to, people are unfortunately going to keep on dying, and they're going to keep, their bodies going to have to be disposed of. And of course, with American population growth, that's a growing thing, plus an aging population, unfortunately, furthermore growing. And as I say, it's very well managed and got good steady growth, partly fueled by the fact the company generates so much cash, it's constantly buying back shares. IDA is a Japanese home builder. We were short this stock because we thought it had three strikes against it. Firstly, the Japanese home building market is now becoming quite saturated. Secondly, it's in part of the business that we're not very excited, geographically it's in part of the country we're not very excited about, which is the peripheral areas of big cities where there's no growth. We used to joke that we don't invest in Japan, we invest in Tokyo. For those of you who don't know, Tokyo has never really stopped growing. Tokyo is still a growth area within a shrinking country. Its population's going up, GDP per capita is going up. It's actually a really bright spot. But peripheral areas of cities are not growing because increasingly as people get older, they want to move towards the centre. So that was the second strike against it. And the third strike against it is it's actually a very badly managed company. We've been looking at this company in various formats for the last 7 years. A bit of background, we originally invested in one of its predecessor companies because we heard they were going to merge all 6 of a group of family companies that were all listed. And we thought, this is great, they're going to get huge synergies. They didn't. They end up having 6 companies with their own head offices and a new head office on top of it, a very Japanese story. So it's a very badly managed company in a shrinking area, in a business we think has got overall macro strains. We've closed that position out. We made quite a lot of money from that short position. Bank Leumi is Israel's largest bank. We like this stock because it's kind of got a very familiar Australian ring to it. The basic way to think about it is like buying CBA after it came out of government ownership, very overstaffed, very not particularly brilliantly managed. And we've got there as an improving management. They're removing the excess of staff. There's not a lot of growth in Israeli banking because basically there's no much demand for loans, but the economy is growing like a weed. We've basically been benefiting here from increased dividends, share buybacks, staff headcount going down through attrition and some voluntary redundancies. And as the headcount goes down, they're still quite overstaffed. They're releasing surplus real estate, which they can then sell. And to give you an idea of how undervalued the real estate is on their balance sheets, a lot of their real estate is still on the balance sheets at the value it had in nominal terms in 1948 when Israel was created. The bank itself dates back to, it's over 100 years old now, but they have this real estate that's ridiculously undervalued. So as they get rid of staff, they don't need to have offices for the staff. They sell the offices, generate profits, have excess capital, buy back shares. Coca-Cola is another short position. Our view is that Coca-Cola runs a fundamentally, it's a relatively expensive stock running an unsustainable business where those externality issues we talked about before are going to come back to bite them. What are those externalities? Basically, they've got 3 problems as far as I can see. Firstly, demand for bottled drinks, and particularly sugary bottled drinks, is going down. So they've got no growth in their core markets, Australia and New Zealand. Secondly, there's an increasing concern about plastic pollution. They're having to take some action about that, and it's caused them some costs in Australia and New Zealand. They're not really doing anything about it in their other key markets of Fiji, Papua New Guinea, and Indonesia. They're going to have to face those costs at some point. And thirdly, we have some issues about the way they report. We think they report to bamboozle. This is part of the governance story, and we think this is going to come back. I'll give you an example. Tell me if this strikes you as being a bit strange. When Coca-Cola reports on a geographical basis, it reports Australia, then it combines Fiji and New Zealand, and it combines Papua New Guinea and Indonesia. Now, when companies report in a certain way, there's usually a reason for it. In our view, they're trying to a little bit hide the growth about the fact there's no growth in New Zealand because Fiji's got growth. But obviously the value of growth in Fiji is less than the value of growth in New Zealand because it's a riskier economy. And it's even more the case in the combination of Papua New Guinea and Indonesia, because Papua New Guinea's got a unique problem, which is that their economy is in very bad shape. So it's very hard to get your profits out of Papua New Guinea back to Australia into Australian dollars. And on that point, we always worry when we find companies that aren't very straight with us. We asked them about that issue, and some of you may know Chad and I independently have had a fair degree of experience with Papua New Guinea. So we said, how are you getting your money out of Papua New Guinea? And they said, no problem at all. And then we said, are you sure? And they said, yeah. But then they had to call us up and say, oh, by the way, you were right, we have a problem. And now they have to disclose it. And we also think that the other reason they hide their Papua New Guinea with their Indonesia division is because actually the business is not going that great in Indonesia, but it is actually still growing in Papua New Guinea. So another form of obfuscation. So this is the way we look at stocks, and we identify things that don't look right from a governance point of view on the short side. I won't go through the rest of these, but that gives you a snapshot of where we are at the moment. I think I probably covered Alstom, let's say a global company. Should have probably had the slide up when I talked about it, but I want to just briefly touch on why it's our biggest position and why we're so excited about it. All around the world, there's a recognition that rail, both inner-city rail and urban public transport, is something that the countries have to invest in. They have to invest in it for any number of reasons, but let's take the developing countries. Most developing countries have got big cities that are literally drowning in cars. I know one of my old friends here has a business in Jakarta. I could ask John to embarrass himself by telling you how long it takes to get around Jakarta, but I can tell you it's a nightmare. I go to India fairly regularly. The worst case of this is Delhi. Delhi is in a sort of like a semi-state called the National Capital Region. It can take literally, if you try and do 4 visits to visit companies in a day in Delhi, it's the most you can ever do, and you can be in a car for 4 or 5 hours that day. A quarter of all the cars in India are in the National Capital Region. So as a result, they're finally, and rather late, starting to roll out quite a good metro system. But all over India, every major city is trying to roll out a metro system. Bit of context here. The first city to ever start to build a subway system in India was Calcutta. They started in the 60s, then Calcutta came under the control of the communists. All investment stopped, so that was it. And nothing else was done for nearly 40 years. But now there's a massive catch-up. So those are 2 good examples of developing countries. In developed countries, we're seeing that even Sydney, in my view, is drowning in cars as well. I have to commute from Bondi to the city every day. It takes me 40 minutes, ridiculous. So we're seeing a big rollout of public transport growth in developed countries as well. And there's going to be more pressure for that in our view because as global economies continue to slow, there's going to be more and more pressure on governments to spend more on infrastructure. And where do you get the biggest bang for your buck? Probably in urban infrastructure, because the population can see what's happening. It's a bit inconvenient down George Street, but they can see what's happening, and they benefit from it quickly. And it's what's called shovel ready, as in you can do it without a lot of planning, because everybody's had plans for it for years. So we think Alstom, as one of the major players in this, and probably one of the most technologically advanced, is really going to be the cutting edge for growth. How much growth is there? Well, their order book, I think, if I'm right, James, I'm going to check. Is it 5 years now of future orders they've got? 5. Yep. But what's more important, that they've got 5 years of future orders ahead of them. Their order book is growing at about 120% of each year's sales. So in other words, every year, the size of that order book is getting bigger, not smaller, not using it up. The other thing is they're very innovative. There's a little blue train on your slide over there, and that little blue train is the world's first hydrogen train. Why does the world need hydrogen trains? It's because although electrification is the obvious way to improve your rail system, to go from diesel to electrification, a lot of routes just aren't big enough to justify the capital expenditure of putting in all that electrical infrastructure. So the obvious solution there is to take the diesel out and put hydrogen in. And what we find very telling is that the first sales, in fact the first 2 sales that Alstom has made for these hydrogen trains has been into Germany. Now, for those of you who know anything about, are there any other train spotters here apart from me? The other major European train manufacturer is Siemens. Siemens is German. Now, obviously everything's done on a merit basis in Europe. Maybe. The fact is, generally, Siemens sell trains in Germany, Alstom sells trains in France, and they both compete in Italy. That's the reality. But Alstom has managed to sell this hydrogen train into Germany, which we regard as clear evidence it's got a technological edge. And why are we so excited about this? Because there's actually a lot of what we call thin diesel routes that will need replacement around the world. We wish that Alstom would succeed in persuading the New South Wales State Rail that should replace the railway networks to Canberra and so on, which are still diesel. These are huge opportunities. We'll have to have a word with them. Anybody's got any influence here, please speak up. So that's why we're so excited about Alstom. It's a real growth company with technological edge and a long duration of growth, if you like, which may even accelerate. Talked about China Everbright. I'm going to skip that slide. I'm going to talk briefly. I talked about our focus on governance. Now, this is a very interesting story. Next time we put this slide, Irene, you've updated it. Thank you. So this has been a very interesting story for us. Bit of background. Panalpina is one of 5 companies, global companies, that are involved in what's called freight forwarding. And for those of you who don't know, if you want to get a container moved from point A to point B, you basically have to book space on a ship or an aeroplane, and to do that, you typically go through a freight forwarding agency. It's quite a nice business because it actually has very little fixed assets. It's mostly just a bunch of people with a Rolodex and a software system. So when it goes well, it gets very high return on capital employed. Panalpina was clearly the worst of these big 5 companies. And it was worst in many respects. It was the least efficient. It was going through a flawed upgrade of its software to a software package which is the world's best software package in this area, from a German company called SAP. But as any of you have ever worked in companies that have installed SAP, it's a very high-risk process. It will transform your business, or it will kill it. And it was showing every sign of killing Panalpina. It was behind schedule, over budget, and not delivering any outcomes. So we actually identified this as a good short candidate, which we did, paired with going long, the best company in the sector, which is a company called DSV, which is a Danish company, which is, how should I put it, aggressive. Very efficient, very focused on profitability, rapidly growing, and so on. So we had a bit of a false start shorting it. Then we tried again and made a lot of money in that second orange leg there. So when the share price goes down and we've got the orange on it, we're making money. And then we walked away. We thought we'd made as much money as we could. But James didn't stop looking at the stock, which was good, because we had all this sunk knowledge about the industry and so on. And he picked up, and I think it's an incredible pickup, this very small change they announced about the makeup of their board. One of the problems with Panalpina is it was controlled by a charitable trust set up by its founder, with quite a lot of opacity about what it was the trust was supposed to be doing. and they weren't really running the company property, or they weren't controlling the company property. So when they announced they were appointing an independent director who wasn't from the trust for the first time, we got excited. We thought there was a message in this, and the message we thought we detected was that the company was preparing itself to be more open to the idea of takeover. I should say that Panalpina has been approached many times by other people to acquire it, and has basically said no. So, lo and behold, within a very short period, DSV lobbed in a takeover bid for Panalpina, and there was then a lot of argy-bargy about the takeover bid, as there should be, but some of the resistance looked like the board digging its heels saying not for sale at any price, which is not a very good thing. We then got very involved in lobbying them to try and be more open to the DSV approach. And then they announced a shareholder meeting to change some of their articles, which would basically entrench the original controlling foundation. And we then got very active. Believe it or not, little Morphic, sitting in Sydney, then wrote to the Swiss Stock Exchange, highlighting the fact that we saw some serious legal breaches in the notice of meeting they'd lobbed in to change these articles. And amazingly, the Swiss Stock Exchange agreed to look at our concerns, and the story got out to the press in Switzerland. And to cut a long story short, we're out of the stock now because eventually the company rolled over, accepted the takeover bid, and we had quite a good return. And that's really, as I say, that opportunity came from obviously our sunk knowledge in the industry, but also our approach to this whole governance part of our ESG mandate. I'm just going to, if I can, just skip to portfolio positioning as at the end of April. We've obviously had we have not done our overall returns have not kept pace with the market in the last year or so. There's a very simple reason for it. There are many reasons, but the most important reason is that we've been underweight the market that's done best. So you'll see on the left-hand side, for those of you investors in the Morphic Global Opportunity Fund, your fund's market exposure is highlighted in dark blue, and for those of you in the Morphic Ethical Equities Fund, your fund's exposure is highlighted in the greyish colour, and the index itself, to give you an idea of what the market weight is, in yellow. So you can see both our funds have been pretty underweight the US. Frankly, with the benefit of hindsight, that's not been good news, because the US market has outperformed every other market, as it has done for most of 7 years, also in the last year or two. On the other hand, and this is the reason why, for those of you who follow other fund managers, we've done rather better than our two nearest competitors, Platinum and Antipodes, is that we've not had this locked-in position of being overweight Asia Pacific. We've actually avoided overweight there. Where have our overweights been? Our overweights have been primarily in India, where, to be honest, we've done better if I've got to be perfectly honest, I'd have done better if I thrown a dart at the board and picked some stocks. We've not added value for our stock selection, but our decision to be overweight India was fundamentally a good thing. And also Africa and the Middle East, which really means Israel, where we've made quite a lot of money. In terms of sectors, we've been underweight energy. That's been a bit of a headwind for us, because as you'll be aware, the oil price has gone up quite a lot in the last year or two, and we've been overweight industrials, which is a grab bag, but includes things like China Everbright, our waste-to-energy company. And we've been a little bit overweight financials, primarily through Israel. I'm going to stop there because I might run out of voice, and also because I know that at 12:15 we've got sandwiches, and I thought we'd have a good time to have some questions and answers now, and I'm sure there's plenty of questions. And Irene at the back there has the microphone. If you put up your hand, she'll take it from you.
Thanks, Jack. Couple of questions. On page 7, where you talk about the charitable giving, that figure of 723,000. Can I just clarify? Is that the foregone fees from the FGG investment?
Correct.
Okay.
So for those of you who don't know, Jeff Wilson, who runs a group called Wilson Asset Management, had a brilliant idea about 5 or 6 years ago, was to create a fund of funds listed on the stock market that would invest in would invest in other funds to generate an investment return for investors. But what he did was he then went around and rang up all his pals around the industry, including us, and said, "Would you mind if we invest in your fund and you give us back the fees?" And we said, when he explained what the concept was we said yes. And so that 720,000 represents the fees we've given up to back youth mental health charities over that time.
And thanks. And the other question, in relation to Coca-Cola on page 14, it looks like you had a short position there for a while.
Sorry.
Which probably didn't go too well initially.
Yep.
Then it went well, but now you're back to holding it again in a short.
Exactly. So thanks for that. That's very helpful. So what we're trying to show you here is the history of our engagement with Coca-Cola. So we had a go at shorting it. It didn't work out. We thought, what are we missing here? And we cut the position. We did more work. And we decided, despite that not only were we not missing anything, but the share price had gone up, so the benefit of shorting it was better. So we had another go, and it went very well. We thought we'd made a lot of money in a short piece of time. The prospects for it bouncing were very good. It bounced. But we saw no improvement in the business. So we're now having another go. It may not work out. If it doesn't work out, at a certain point we'll cut our losses and move on. But we won't stop looking at it, and we'll hope to have another go. But our view is that the fundamentals of the business are not getting any better, and the price is too high, and the pressures from regulators to deal with the global obesity problem and with the packaging problem are only going to get worse. Microphone.
Two questions. You wouldn't believe it, but I've never heard of your company until I got an email out of the blue, and I'm involved in investing in lots of companies. Now tell me this, are we talking about investment in one company, and investing in 3 companies? And is there someone that can give me the ASX code so I can get someone else's opinion? The second question with regard to charity. I come out of the military, and we're very deeply involved in the charity of widows and soldiers that have lost their marbles and so on. How would legacy, for example, become of an interest to your company?
Okay, well, the first question, so as I explained before, this is a meeting for investors in our Morphic Ethical Equities Fund primarily, but also for investors in our listed investment trust, in our investment trust, which is called the Morphic Global Opportunities Fund. So there's 2 main ways you could invest with us. One is to invest through our listed investment company, which is the stock code is MEC. And the advantage of that, to be honest, is you can invest at about a 20% discount to the value of the underlying investments we have. But on the other hand, you face liquidity risks in doing that. You may not be able to sell when you want to. The alternative is to invest in our unit trust, which is the Morphic Global Opportunities Fund, which you can invest just through our website. And the advantage you've got there is you're always buying and selling, or buying and redeeming at net asset backing. So you've got no liquidity risk, but you don't get the advantage of the discount. I hope was that to answer your first question?
Yes, it does.
Good. And my colleague Irene will take your details and we'll give you a call afterwards. Now, in terms of legacy, one thing I've learned, and I've been a very slow learner, is you can't be all things to all people. No person is big enough to do that. So we've decided to focus our charitable giving as a business on 2 areas. One is youth mental health, which will address in part your legacy, the issue about the soldiers who've got post-traumatic stress syndrome, and that's one group of charities we support, and the other group of charities is Bush Heritage, which we think is was Australia's most efficient organisation, more efficient than state governments at dealing with problems of land degradation and species loss. I'm very sympathetic to your concerns about PTSD. My father was a member of US Special Forces, and I'm not sure whether he was mad beforehand or mad afterwards, but certainly he was mad afterwards. But he clearly had problems related to that. And I've got nephews who've been in the Australian Special Forces, and one of my nephews said, there's two kinds of people who've been in Special Forces: those who know they got PTSD and those in denial. So it's a really big issue.
Thanks for your presentation, Jack. I was just wondering if you could just outline the investment thesis for the short position in Woolworths.
Yes, I can. I could probably, if Chad's willing to, let Chad address that issue. Chad, my colleague Chad can.
We don't have a slide on Woolworths, but the stock is fairly well known, I assume, to everyone in Australia here. Now, Woolworths, we can't own it from the long side, so because of their ownership of pokies and also the sale of liquor. But it is a stock that we can short, and remembering, whilst we can't own negatively screened stocks on the long side, we can always short them. I've covered Woolworths on and off as an analyst for the better part of 18 years, and Woolworths, here's an interesting thing today. Woolworths' earnings for next year is going to be about $1.50 on Morgan Stanley's consensus numbers over there, approximately. This business earned $1.50 13 years ago. So for all the talk about this being a great business, very rarely do great businesses earn less than what they did a decade ago. That would be my starting point. You compare that to, say, Google, Apple, these sort of businesses. And what should one pay for this privilege of a business that earns less than what it did a decade ago? Well, you're currently paying about 25 times earnings for that. That, to me, is a growth multiple. So normally when you pay 25 times earnings, or for a Cochlear type business, you expect your earnings to grow because you don't get a very high dividend yield. The yield on the stock is about 3%, for example. Now they had a special return of capital post the sale of their assets. So it's primarily valuation. It's a business being priced at a multiple that's not consistent with its growth prospects. So it did trade on 25 times once, going back to 2006. At that point, it used to generate about 15% EPS growth when it was growing fast, before Aldi really got to a large size. So you're getting half the EPS growth at a higher multiple for no more capital return, and the EPS growth next year is predominantly going to come from Big W. So if you decompose the earnings numbers, so if you get higher earnings, how are you going to get it? Generally, the food business and liquor business are considered the creme de la creme inside that. It's Big W generating most of your earnings growth. I would say Big W's worth a PE of 8, maybe. Look what Myers is worth. So it's nearly all valuation. I don't have a catalyst in the sense that it's going to miss earnings in the short term. My other catalyst, I would say in the medium term, is Aldi hasn't gone away. And the liquor business is slowing as well. So I think what you'll find is earnings don't work out in the next 2 years to be anywhere near as good as people think, and the stock will largely derate is the main thesis on there at the moment.
I might add two additional points I see in this. One is that not only is competition not getting any better, but you've got a new player coming to the marketplace, another German, what's called a hard discounter called Kaufland, has signaled it's going to arrive here. My guess is that Aldi, which has not been as aggressive on margins as you might have expected, is probably keeping a bit of reserve for them. And finally, we've got the question of online shopping for groceries. Coles, I think, has done a very smart thing. They've announced a joint venture with Ocado, which is probably the world's leader in terms of allowing supermarkets to become efficient at online shopping. Bit of history here. Anybody here ever been to Memphis? It's a dusty, poor city on the edge of the Mississippi River. But believe it or not, that's where the supermarket was invented by a chap who ran a store called Piggly Wiggly. You can still find Piggly Wigglies in South America. And his brilliant innovation was to recognise there was a huge inefficiency in his grocery store. So the way it worked was he stood at the front of the bench in front, and people would queue up to come and give him their orders. And they would say, I want 3 of this and 4 of that and 5 of the other thing. And you have an army of clerks standing behind him. And the army of clerks would go up ladders and pull stuff off shelves, and it all brought together, and you put it in a brown paper bag and give it to the customer. Well, you can see that wasn't a very good model. People had to queue to get their goods. He had to have all these staff picking stuff off shelves, and obviously his throughput was very poor. So his brilliant innovation was to say, let the customers pick up the stuff themselves, bring it to a common place, and let them pay for it, having assembled the group of goods themselves. That was the birth of the supermarket. So you think about online shopping, it actually involves going back to the pre-Piggly Wiggly days. What it means is the shop has to go and pick up all the stuff from the shelves, put it in paper bags, and send it off to the customer. The only thing that's changed between online shopping and the pre-Piggly Wiggly days, you no longer have a queue of customers. But from the shop's point of view, the inefficiency is they have to have the row of the clerks behind them to take the stuff off the shelves. So why are we more positive about Ocado's or Coles prospects in online shopping than Woolworths? Because Ocado runs basically a robotized stock picking system inside massive warehouses, so you don't have to have the labour to go back to the pre-Piggly Wiggly days. So these are really big technological changes that are going to be needed to make online shopping work, yet people want online shopping. Sorry, Stuart, and then...
Thank you. Jack, I was interested in your comments earlier about the governance side. The E and the S of the ESG to me seem pretty straightforward, exclusion and various activities of the corporates that you're analysing. How do you stay on top of it? Like, if you've got an audit to start with, but then there's constant change within a company. There's director changes. There's new initiatives companies are looking at. How often do you revisit that and stay on top of the fact that the governance is still there?
Okay, that's a very good question. I mean, actually, I have to say that you think there's a lot of change, but actually most of the time there's not much change. Sometimes for the bad, by the way. We wish there was more change, but companies, obviously we stay on top of all corporate news as a matter of course, but the big event for most companies in almost every country is an annual general meeting. And typically that's where they announce major change to governance. Like, obviously we get very excited if we saw them seeking to reduce the number of independent directors on the board, but typically what we're looking for is governance to improve. And so we're looking out for signs of improvement, which could be a signal for us to buy more of the shares. But the answer to all this stuff is, it is a complex world out there. There are, I think it's 60,000 shares, 10,000 companies we can invest in that meet our minimum size and liquidity requirements around the world. We think it's a hopeless task to try and cover 10,000 stocks. If you take out roughly 7 or 8% of that we can't invest in because our negative screens, it's still a huge number. So the result of that is we have to look at certain sectors, certain countries, focus on those. Whenever we've owned a stock, it becomes part of our, if you like, the collective intelligence of the organisation. We maintain files on them. And so if we see, our job is to just keep on top of stuff. Plus we run screens to look at stocks where they may come into an interesting perspective from a valuation point of view. At that point, we will have another look at it and see if there's a change. But stuff we already own, not too hard to monitor. Sorry, question in front here. Irene's just coming.
Thank you. I'm just wondering whether MEC holds any shares in Costa Group.
Costa? No, we don't. No.
Okay. Thank you.
Can I ask why?
I was just curious. I know it's based on agricultural production, and typically these sort of companies have their ups and downs because you can't predict weather that well. And I just wanted to learn about possibly Chad's view on that company, just out of curiosity, if he has a view, for example.
I wouldn't feel comfortable offering enough a view on that.
Okay, that's the reason. Thank you.
Thank you. Everybody feeling a bit lunch o'clocky? Or there's another question over here, sorry.
You mentioned the fact that the valuation of Morphic is considerable discount to its assets. Seems to me that that's a portent of harder times that are coming in the perhaps near future. Do you have any strategies as to what you do differently in this situation than you might be in a more optimistic atmosphere?
Okay, so the first thing to say is that unfortunately almost every listed investment company in Australia saw its discount widen with the prospect of Bill Shorten's ALP winning government and the value of franked dividends going down. It shouldn't have mattered quite as much for us because although we pay a franked dividend, it's not a huge portion of. We've always said people should look at us as a growth company rather than a dividend stream company, even though we have paid dividends earlier than expected, will continue to do so. But that discount widening has, for some reason, not unwound much since the election. And that's true across the board. Your comment about it being a portent of harder times, I'm not sure. I'm always looking for excuses that are external to us rather than internal to us. I don't really think I can take much comfort from that. I think that generally speaking, this is no guarantee, when global markets start getting soft, it's usually a sign that global growth is slowing. And when global growth is slowing, usually the Australian dollar goes down, so normally we get a bit of offset there. Plus our fund is able to go long and short, and we're also able to raise cash. So we should be able to, I'm not going to guarantee we do, we should be able to navigate our way through those times. I think the bigger issue, to be brutally frank, is that we looked at this issue of discount, and there's quite a high correlation between the size of a listed investment company and the level of discount. The bigger the fund, the lower the discount. And unfortunately, we're a bit small. So if I might just be, again, this is not great news for anybody, but the fact is, people like me, most of the people in this room already own LIC shares in the MEC, are obviously frustrated about the level of discount. But the hope is that the level of discount actually is a bit self-correcting, and that people, because we go out and tell the story, every 6 months we go around the country and tell the story in detail, plus we communicate regularly with shareholders and prospective shareholders. The hope is that some people see that discount as an opportunity, buy the shares, and that helps to partly close the discount.
I hope you're right.
So do I. Two more questions here, sorry.
Hi, I'm just interested in your merger with Elliston. So will Morphic become Elliston, like changing the names?
So, in case you couldn't hear the question was a question about issues arising from our merger with Elliston. So there are no plans that I'm aware of. I don't think there will be any plans to change the brand. I mean, I think Morphic, for what it's worth, we're for a relatively small and relatively young business, our brand has got reasonably high profile. And I think that's part of what Elliston's bought. In terms of our operations, we went to see our new office space yesterday. It was actually, I was very touched, actually, to be honest. Elliston had given us a beautiful office space within their office where the team will sit together. But I think from our perspective, and I think I speak for Chris as well here, what we all want to come out of this, Morphic and Elliston, and the future merged company, is to take all our intellectual property that is invested in our investment teams and get more value from it across more funds. Elliston has got some incredibly good analysts who cover sectors that we don't currently cover. So we're looking forward to being able to have access to those ideas. And I hope that the Elliston team will also have the same view about some of our ideas. You've heard from our analysts, and we've got some very, very smart people. And I hope that that's going to be an opportunity as well. So we're really excited about this being 1 and 1 equaling substantially above 2. At the same time, from our point of view, and I really want to stress this point, there were 11 people at Morphic. There'll be it's a small but not tiny business. I've discovered, to my shock, that 11 people require management, especially me. I need my own management, and I'm really going to be relieved about not having the day-to-day responsibility of doing a not particularly brilliant job managing a small business. Chris, did you have anything to add?
I suppose, actually, I'll grab the mic if that's right. I suppose there's obviously been a lot of interest as to why Ellison bought Morphic, and just some additional comments to what, Jack said. I mean, for us, it's just part of our strategic evolution, and if we looked at what, Morphic had to offer from a product set, it was very complementary to what Ellison had. So we're just continuing our journey of being able to offer, greater product variety across our platform. That was the first point. And the second point, which Jack alluded to, was, we could tell that the thing that Morphic lacked was corporate infrastructure, and that's something obviously that Ellison brings to the table. So it can bring back office support, middle office support, obviously marketing, greater marketing support and distribution support. And most importantly, as Jack kind of touched on, the ability to leverage our intellectual capital across to Morphic and vice versa is going to be very, very powerful, because we've got around about 80 people now in Ellison or thereabouts, or 75 people. So there's great scope to be able to share that knowledge across the platform and across all team members. I see that as a very, very kind of strong outcome from this transaction. And I think the other thing to highlight is that, I think culturally, Morphic was just a really, really good fit from the people that are there. We're very like-minded, which is critical, because when you obviously acquire any business, doesn't matter if it's an asset management business or, as you would know, any company, the culture is absolutely paramount to the success of the organisation. I think that's where we're also going to have some great fit. So we're very excited about the opportunity.
And I also, as am I. I mean, my basic excitement is I haven't been to Japan or India this year to do any company research, and I'm dying for to talk to Chris about when I can do my first trips up to Japan and India, because I feel I'm not just not saying I'm out of touch completely, but I'm just not as in touch as I would be if I'd been on the ground more.
Approximately a year ago, there were options on MEC pending exercise. Am I correct in believing that there are no more options pending? And of course, those pending options at the time were possibly part of the cause for the discount, the NTA discount?
Yes, there are no options on issue at the moment, and I don't think you'd like to be any for the near future, or even the medium-term future. We did think that the options were cause of the discount, but frankly, the problem is the expiry of the options did not close the discount the way we thought it would. I'm sorry to say that. I think partly it was timing, by the way. The options expired at a point when the stock market had a bit of a swoon, from which it's fully recovered, but I think that was, the whole thing came together in a slightly bad way.
So just reconfirming, my understanding that there are no more options is correct?
Yeah, the only listed security on the stock market for Morphic Ethical Equities is MEC, nothing else.
Thank you.
What's the shareholding of MEC?
You mean, so who...
Is Elliston?
No, Edison did
Elliston's relationship.
Ellison does not own any shares in MEC, other than a handful that they own through Morphic Asset Management owns a handful of shares in MEC, so that's the only shareholder they have. But I retain my personal 500,000 plus shares.
And Cons Press?
I'll let Chris speak to this one in more detail. But my Cons Press, for historical reasons, still owns 25% of Elliston. But they have no, I'm correct in saying, Chris, they have no management involvement. No. It's a purely financial investment they have in the business. I feel it's lunch o'clock. I'm not going anywhere. I'll be ready to answer questions for those of you who are too shy to put your hand up and get a microphone, as will my colleagues be. So let's go and get a sandwich. Oh, there they are.